Welcome to Valuation in under 5 minutes. Today we are valuing Oracle. Oracle just came out with their Q4 earnings. Oracle as a corporation is an American multinational computer technology corporation headquartered in Austin, Texas. In 2020, Oracle was the third largest software company in the world by revenue and market cap. So it's a top 3 software company. The Oracle's massive. It's probably the least known out of the big software companies. But what it is, it's a cloud. They sell cloud services to large organizations. Let's go straight into the valuation. And what I'm seeing here, let's check out where my growth numbers are from. So growth of 4.4. This is all the analysts. The analysts are saying 8.13 is a historic growth. That makes sense. 8.13, I'll take that. And 26% is the average profit margin and free cash flow margin. Profit margins are about 25%, free cash flow is 33%. I'd take 26%. Fair enough. Then let's see what we get as a valuation. I took minus 19 in net debt. They have big amounts of net debt. This was my big red flag. This is 9 years of debt. 9 years of free cash flow to pay off their debt. So there's a huge amount. There's actually one thing which I will change. It's instead of 5 years of average sales, I will change it to to last year's sales. Last year sales. And change it on here. I think last year's sales is more accurate as this is a growing company. You always want to use the most recent year's sales. Why is this? Yeah, that makes sense. So there we go. Minus $19. They've got too much liabilities, too much debt. This is why I'm scared of this company. The reason I was listening to their conference call for Q4, and they said the reason for debt, as we can see over here, the reason for debt is due to purchasing a new business. I forgot what they mentioned their business was. But that's fair enough. So that's a good reason to bring on debt to buy a new business, as long as the business is going to grow. That's fine. But then what I didn't like about it is that they're not willing to, like when a company brings a debt and that high debt, 10 times the amount, they're not willing to budge on their dividends paid, which most companies don't, because as soon as you lower your dividends paid, stock crashes. That's what market sentiment, that's how it works. But repurchase of stock, they didn't really want to budge much from there either. So they just really want to just let it run and get the free cash flow from next year to slowly pay it off. And then that means that there's going to be high debts for a while to come. If I was a business, I'd want to lower my repurchase of stock, especially now. Although now that price is coming down, maybe not. But look at this, they're purchasing stocks when there were high multiples. So let's just go back to the valuation as it's getting close to my 5-minute mark. So this means that my stock, the current stock price, the stock price that I value it is at 38. I would sell at 70. Current price is selling at $70. So this is actually where it's currently selling at. So if you believe these figures, I would be buying, but for me, that's too unrealistic to go at 8.1% a year. Yeah, I'm considering this one a hold just.